Imagine you're standing in a crowded brokerage office in Manhattan, September 1929. The ticker tape machine is clicking nonstop. Your clients are calling every hour asking where they should put more money. Stock prices are hitting records daily. You just read in the morning paper that Irving Fisher, the most brilliant economist in America, has declared that stock prices have reached what looks like a permanently high plateau. He's not some random talking head. He's a genius at Yale. He's studied the data exhaustively, and the data backs him up completely. Here's what he sees. Revolutionary technologies have just transformed the entire country. Radio is connecting millions of homes for the first time. Automobiles are replacing horses on every street. Electrical grids are powering factories that produce more in a day than previous generations could in a month. The future looks unlimited. A share of Radio Corporation of America, the hottest stock of the era, has climbed from $11 to $114 in just a few years. It's the Nvidia of 1929. Every valuation seems justified if you believe the old economic rules have been permanently rewritten. You're a smart investor. You look at the same data Fisher sees. Industrial production is breaking records. Consumer spending is robust. The newspapers are filled with articles explaining why prosperity will last forever. The concept of recession has been psychologically abolished. Modern economics has evolved beyond boom and bust cycles. Everything points to a new era where markets only go one direction. Up. Fast forward 97 years to today. You're scrolling through your phone, checking your brokerage app. The S&P 500 just hit another all-time high. Artificial intelligence is the revolution that promises to remake every industry. Productivity gains will make old valuation metrics irrelevant. The talking heads on financial television explain why this time really is different. You have your own Radio Corporation of America. It's called Nvidia or Microsoft, or any of the magnificent 7 technology stocks that seem to defy gravity. Zero-day options let you leverage your bets 100 to 1 from your smartphone. The mechanisms changed from margin accounts at brokerage windows to derivative contracts on apps. But if you look closely, the psychology is identical. The belief that central banks control gravity and trees can grow to the sky. The 1929 pattern isn't about the crash itself. Everyone knows about Black Tuesday. The critical piece, the part that constitutes the 90-day warning, is what happens in the final weeks before everything breaks. It's a phenomenon market historians call the melt-up. The biggest gains in a bubble often arrive at the very end. Summer of 1929 saw markets surge nearly 30% in 3 months. Vertical ascent. This final rally serves a specific function. It forces the last skeptics to capitulate. When the final pessimist buys in, there's nobody left. The market runs out of buyers. We're watching this dynamic unfold right now. Walk into any trading floor today and notice the concentration. In 1929, the rally was driven by utility holding companies and investment trusts. Today, the S&P 500 is effectively 5 or 6 technology conglomerates. Strip away the AI giants, and the average American company is struggling with high rates and falling demand. The index lies just as it lied in 1929, but the most critical signal isn't in equity markets, it's in the bond market, specifically in the behavior of the yield curve. 1, the curve and the countdown. Typically, lending money for 10 years pays more than lending for 3 months. You're compensated for duration risk. But before every recession in modern history, this relationship inverts. Short-term rates rise above long-term rates. This happened in 1929, in 2000, in 2008, and it happened again in this cycle. The inversion is the warning light on the dashboard. But here's what most analysts miss. The crash doesn't happen when the curve inverts. The crash happens when it uninverts. When the curve steepens back to normal, that's the signal that something broke. Why? Because the curve uninverts when the Federal Reserve suddenly realizes they've over-tightened. When the economy starts cracking, they panic and aggressively cut short-term rates trying to save the system. This causes the short end to collapse, restoring the normal slope. In 1929, the yield curve uninverted just weeks before the crash. In 2008, it uninverted just before Lehman Brothers failed. The uninversion signals that the soft landing was always a myth and the hard landing has arrived. Right now, in 2026, we're watching the curve steepen back toward positive territory. The Federal Reserve is cutting rates, telling markets they've defeated inflation and secured a perfect outcome. But history screams a different message. They're cutting because they see liquidity evaporating in the financial system's plumbing. They're cutting because the patient is in cardiac arrest, not because the patient is healthy. The danger is amplified by leverage. In 1929, investors bought stocks on 90% margin. $10 down controlled $100 of stock. A 10% decline wiped out 100% of equity. Today, we have shadow leverage. Hedge funds lever 10 to 1 using treasury basis trades. Retail traders lever 100 to 1 through options. The system is tighter and more fragile than it appears. When selling starts, it triggers a liquidity cascade. As prices fall, margin calls go out. To meet those calls, investors must sell their best assets. They don't sell what they want to sell. They sell what they can sell. This is why correlations go to 1 during crashes. Gold falls, bonds fall, stocks fall, everything moves together. In October 1929, the market didn't just decline, it evaporated. There were moments on the NYSE floor where there were simply no bids. You held a share worth $100 yesterday that you couldn't sell for $1 today. The psychology follows a specific progression, from greed to complacency to fear. We're currently transitioning from greed to complacency. The VIX sits at historic lows. Investors are selling insurance against crashes because they believe crashes are impossible, picking up pennies in front of steamrollers. In September 1929, newspapers ran articles explaining why prosperity would last forever. Industrial production was robust. Consumers were strong. They were looking in the rearview mirror while the road ahead curved sharply. The melt-up we're experiencing is partially mechanical. As smart money exits troubled sectors like commercial real estate and private credit, that capital has to go somewhere. It flows into the magnificent 7 technology stocks, pushing them even higher. This creates a barbell economy, hyperinflated AI stocks at the top, disintegrating real estate and small business at the bottom. This divergence cannot persist forever. In 1929, it snapped when banks called margin loans. In 2026, it snaps when regional banks are forced to recognize losses on real estate portfolios. 2. The maturity wall. Today, the leverage is hidden in commercial real estate and the shadow banking system known as private credit. This is where the mathematical inevitability of the crash resides, behind opaque accounting and regulatory forbearance that's running out of time. The problem is the maturity wall. Commercial real estate loans aren't 30-year mortgages like residential properties. They're typically short-term interest-only loans that balloon after 5 years. The borrower pays interest, then at maturity must repay the entire principal, usually by refinancing into a new loan. In 2026, approximately $1.8 to $2 trillion of these loans are maturing. This is the wall. These loans originated during the zero-rate era of 2021. Office buildings were full. Interest rates were 3%. Today, those buildings sit 20 to 30% empty due to permanent remote work shifts. And the refinancing rate is 7 to 8%. The mathematics are catastrophic. The building generates less income while the mortgage payment doubles. According to National Bureau of Economic Research data, nearly 44% of all office loans currently exceed the property value. The owners are underwater. In a rational market, borrowers would mail the keys back to the bank and walk away. This is already happening. Major landlords like Brookfield and Blackstone have defaulted on trophy properties in Los Angeles and New York, but the real crisis isn't the landlord, it's the lender. This brings us to the regional bank trap. In 1929, thousands of small rural banks had bet everything on agricultural land prices. When crop prices fell, those banks failed, triggering cascading defaults. In 2026, the agricultural land is the suburban office park in downtown Tower. The systematically important banks saw this coming and reduced exposure. JP Morgan, Bank of America, they're insulated. But regional banks went all in. Regulatory data shows that small and mid-sized banks hold nearly 70% of all commercial real estate loans in the United States. For many of these institutions, CRE loans comprise 40 to 50% of their total loan book. If those loans default, the bank becomes insolvent. We saw a preview in 2023 with Silicon Valley Bank and Signature Bank. But those were interest rate failures. The coming wave is credit failure. A realization that the collateral backing the loans is worthless. The government saved banks in 2023 with the Bank Term Funding Program, allowing them to pledge underwater bonds at par. But you cannot pledge an empty office building at par. The Federal Reserve cannot print tenants. The most terrifying chart is the vacancy versus debt service ratio. In San Francisco, Chicago, and New York, office vacancy exceeds 20%. But the expenses of running those buildings have skyrocketed due to inflation, insurance, taxes, maintenance. This creates negative equity spirals. The building is worth less than the land it sits on. When the bank takes possession, they don't get an asset. They get a liability. They must pay property taxes and security for an empty shell. This burns through capital reserves at extraordinary speed. Watch the KBW Regional Banking Index. If you see it diverge from the S&P 500, if technology stocks hit all-time highs while regional banks hit 52-week lows, that's final confirmation. The market is telling you the plumbing has burst even if the party upstairs continues. 3. The shadow banking collapse. They take money from pension funds and insurance companies and lend directly to risky companies that traditional banks won't touch. This industry exploded from $400 billion in 2010 to over $2 trillion today. It operated entirely in a Goldilocks environment of low rates and no defaults. Private credit has a fatal flaw. Mark to myth accounting. Unlike banks or public bond funds, private credit assets don't trade on exchanges. There's no daily price. The value is determined by the fund manager themselves. This creates perverse incentives. If a borrower struggles, the manager doesn't want to mark down the loan because that would hurt performance numbers and scare investors. So they extend and pretend they lend the struggling company more money to pay interest on the old debt. They call this payment in kind. It's a Ponzi structure wrapped in sophisticated language. The 90-day warning likely triggers when this volatility laundering breaks. It won't start with stock market crashes. It starts with a gating event. A major private credit fund or non-traded REIT announces suspension of redemptions. Investors, realizing their stable 10% returns were illusion, will try to withdraw. The manager says, sorry, we can't sell assets fast enough. Gates are closed. This happened to Blackstone's Bright in late 2022, but they stabilized it. In 2026, with the maturity wall hitting, there will be no stabilization. When gates close, panic spreads to pension funds and insurance companies that allocated billions to these supposed safe alternatives. They suddenly realize they're holding illiquid assets worth 60 cents on the dollar, not 100. To raise cash, they must sell what they can sell. Liquid stocks and bonds. This is the mechanism of contagion. Rot in private markets forces fire sales in public markets. The leverage moving from visible to invisible. In 1929, it was stock margin. Today, it's shadow banking leverage hidden in structures most investors don't even know exist. The system is far more interconnected than a century ago. A default in a private credit fund in New York triggers margin calls for pension funds in Tokyo. The warning is effectively a countdown to when mark to myth meets mark to market, when illusion shatters against reality. And, just like in 1929, authorities will insist the banking system is sound and resilient right up until the Friday afternoon they seize the banks. 4. The choice and the endgame. Market crashes are painful but recoverable. The true horror is what happens after, when government attempts to fix it. In the 1930s, the Federal Reserve made a historic error. They allowed money supply to collapse by nearly 30%. They let banks fail. They let credit contraction run its course. They forced the economy into deflationary depression that lasted a decade. Central bankers of 2026 have studied this history extensively. Bernanke, Yellen, Powell. They've all sworn implicit oaths to Milton Friedman's ghost that they will never allow deflation again. And this is precisely why the outcome of the 2026 crisis won't be another Great Depression. It will be a great inflation. When the maturity wall hits and regional banks begin dissolving, the Federal Reserve faces a binary choice. Option A, allow deflationary collapse that wipes out debt, but also wipes out the government's ability to pay its own bills, leading to sovereign default. Option B, print enough currency to monetize the entire debt stack, corporate, real estate, and sovereign, sacrificing the currency to save the system. There is zero doubt which path they choose. They choose the print. It won't be polite rate cuts. It will be a fire hose of liquidity that makes 2020 COVID stimulus look like a rounding error. They will implement yield curve control, by capping long-term rates to prevent government bankruptcy. They will buy underwater commercial real estate bonds at par. They will guarantee every deposit regardless of size. This triggers the final phase, described by Austrian economist Ludwig von Mises as the crack-up boom. In a normal boom, people buy stocks because they believe companies are growing. In a crack-up boom, people buy stocks because they're terrified of holding cash. They realize the central bank is committed to destroying currency to save debt. Psychology shifts instantly. Investing becomes capital preservation, not appreciation. You buy the S&P 500 not because you love Apple's earnings, but because Apple is a real asset and the dollar is a melting ice cube. The German stock market during Weimar Republic is the roadmap. In 1923, German stocks rose by millions of percent. Your portfolio in paper marks made you a billionaire. But in real terms, priced in gold or bread or energy, the market actually fell. Currency was collapsing faster than stocks were rising. This is the crack-up boom trap. It creates wealth illusion. This environment destroys the middle class holding wealth in cash and fixed income pensions. It enriches asset holders who own land, gold, and equities. This leads to what historians call a fourth turning, a period of intense social and political upheaval occurring roughly every 80 years. 1780s Revolutionary War, 1860s Civil War, 1930s Great Depression, 2020s sovereign debt crisis. During fourth turnings, institutions holding society together lose legitimacy. When the public realizes money is rigged, that government is actively stealing labor through inflation to bail out banks, the social contract snaps. In this environment, safety lies only in assets with no counterparty risk. This explains why central banks globally, specifically China, Russia, and Poland, are buying gold at record rates. They're preparing for the end of the fiat dollar system. Gold is the only financial asset that isn't someone else's liability. It cannot be printed. It cannot be defaulted on. In deflationary crashes like 1929, cash is king because it buys more. In inflationary collapses like 2026, cash is trash and hard assets become the arc. But governments know this. They know capital flight into gold and alternatives accelerates dollar collapse. The 90-day warning isn't just about market timing. It's about regulatory timing. As crisis deepens, financial iron curtains will descend. Capital controls preventing money from leaving the country, windfall taxes on precious metals and crypto. In extreme scenarios, a repeat of Executive Order 6102. In 1933, Roosevelt didn't just devalue the dollar. He criminalized gold ownership. He forced citizens to surrender real wealth for paper money, then devalued the paper. The government cannot tax its way out of this debt. It cannot grow its way out. It must inflate its way out. And to do that effectively, it must trap capital in the burning building. The warning signs flash red. The yield curve is uninverting. The commercial real estate maturity wall is crumbling. Insiders are selling stock at the fastest pace in years. CEOs and billionaires are building bunkers, buying farmland, acquiring second passports. They're engaging in personal de-risking while telling the public the economy is strong. The window to act is the complacency phase we're in now. Once panic starts, liquidity disappears. You cannot buy fire insurance when the house is burning. The premiums become infinite. The pattern is not prophecy, it's mathematics. Leverage and debt always resolve the same way. The only variable is who holds the bag when the music stops. In 1929, the public held it. In 2008, the public held it. In 2026, the bag is $35 trillion in unpayable sovereign debt. The bill is being prepared. The delivery date is being calculated. The 90-day countdown isn't a prediction. It's recognition that the same mechanical forces that destroyed markets in 1929 are active right now in 2026, just operating through different instruments in a system that's exponentially more leveraged and interconnected than anything that existed a century ago. History doesn't repeat precisely, but it rhymes. And the rhyme scheme between September 1929 and January 2026 is undeniable. Overextended technology sector. Central bank believing it mastered the business cycle. Retail public all in on markets. Yield curve screaming recession while politicians scream recovery. The clock started ticking the moment the Fed signaled the first cut. We're in the final round now. If the melt-up is the fireworks keeping the crowd looking up, the real danger is the fuse burning quietly along the ground. In 1929, that fuse was visible margin debt. In 2026, it's hidden in commercial real estate and shadow banking structures that most investors don't even know exist. The math is identical. The outcome will be familiar to students of financial history. The leverage always unwinds. The only question is velocity. And based on the concentration of risk, the interconnection of counterparties, and the scale of hidden liabilities, when this one unwinds, it won't be a slow-motion train wreck like the 1930s. It will be instantaneous. The system is built for speed now, both on the way up and on the way down.